Today, Japan's central bank cut its annual growth and inflation forecasts, with analysts warning weaknesses remained. I'm joined now by one economist with Oxford Economics, Michael Taylor, to look closer at this news. So, Michael, the Bank of Japan has trimmed back its annual growth and inflation forecasts. Had they been too optimistic about the strength of the Japanese economy? Do they remain so?
Yes, I think they were a little bit optimistic on, especially on growth, where a 2% outcome was definitely optimistic. But it's still quite a strong forecast they have at 1.7% for this fiscal year. But I think it's a realistic one. There is evidence of momentum in the Japanese economy, which we saw in the first quarter of this calendar year. And whilst some of the monthly indicators have been a little bit mixed, the overall momentum and sentiment for the Japanese economy, I think, is still quite strong. So I think they are right to go for a figure of around about 1.7% for this fiscal year. Further out, their inflation forecasts have only been reduced very slightly, and I think that's probably due to the expected fluctuations in energy prices. So I wouldn't put too much store on the change in inflation forecasts.
The official second quarter GDP data is due next month. With this downgrade, are they hinting at a disappointing second quarter?
Well, I wouldn't necessarily say it will be disappointing. It may well be certainly not as strong as the first quarter, which was 1% quarter on quarter. But it may well be in the sort of 0.5% range rather than much stronger, which the first quarter number was boosted significantly by an inventory build-up, which you would not expect to have carried on into the second quarter. So I think perhaps it's a reflection of the fact that the first quarter was particularly strong, and therefore there will be some sort of pullback in the second and third quarters of this year. I don't think it reflects necessarily a change of fundamental view by the Bank of Japan. I think it's just an indication of the profile of growth this year. I mean, for the second quarter, obviously the export and the consumer spending numbers, the monthly data has been a little bit mixed, which might suggest a slightly slower underlying pace of growth in the second quarter. But I don't think it's not a significant shift. And the most recent monthly data, certainly on the consumer side, have been quite strong.
How do you think the Bank of Japan will respond? The central bank has already pushed back its 2-year timeline for hitting its inflation target, and more delays could hurt the credibility of its easing measures.
Yes, I don't think they'll rush to change policy or to ease further. Clearly, they're already doing a considerable amount of monetary easing, buying 80 trillion yen's worth of assets a year, and I think where they find some comfort, I think, is in the fact that inflation expectations have appear to be quite well anchored. The most recent surveys of those consumers and businesses in the quarterly Tankan survey did show that inflation expectations were reasonably well anchored, and the Bank of Japan, I think, seemed to make quite a big thing of this. So I think they perhaps place more weight on that than on the actual inflation data, which may well turn negative in the coming months if energy prices come off. I don't think that will be sufficient by itself to trigger more quantitative easing. I think in order to get more quantitative easing, you would require some evidence of a significant slowdown in the economy, as well as perhaps a greater fall in inflation than they currently expect. I mean, the Bank of Japan say they expect inflation to be around zero in the coming months, and I think that is something I would agree with. So I don't think the Bank of Japan will be rushing into more quantitative easing simply on the back of these changed forecasts.
A weak yen has boosted the bottom line for many Japanese exporters. Is this the economy's saving grace?
Well, yes, it has been a major impact. I mean, perhaps the most direct channel through which quantitative easing has worked in Japan has been the effect on the currency, and with a lagged effect, the boost to exports that has brought about. That clearly we would expect to to continue. Oxford Economics expects the Federal Reserve to increase interest rates later this year, and as a result of that, we think the yen may well weaken a little bit further against the US dollar, providing a bit more of a boost to exports and corporate profits. I think the key thing is not so much on the corporate side; it's to get the consumer going on a sustained basis in Japan, and I think that requires the corporate sector to spend its accumulated cash surplus either on greater investment or on dividends or in other ways in which cash can be returned to shareholders, and therefore boost the incomes of households and get consumer spending going. Because on the labour market side, although unemployment is low and labour demand appears to be quite strong, the labour market earnings remain very, very weak, and disposable incomes on that basis will not be particularly strong. So that is a downside risk. And in the meantime, yes, it's the lower currency, higher exports that have been driving things.
Some great insight from Michael Taylor there. For more analysis and market insight like this, make sure you're clicking back to Dukescopy TV.